So we're joined today by 4 highly regarded investment companies that are going to share their own perspectives on how they are advancing their efforts on ESG and why they're doing that. We've got quite a lot of content to cover, and we will be covering a lot of topics, including the capital market flows, the impact of changing regulation, what they're seeing on the operational front, and also the challenges that they're facing. So I'll just start by sharing a few brief observations. 3 to 4 years ago, it was really only the large institutions that were making commitments, and it's more about data collection. It still is, actually, but what we're seeing is that there are real tangible projects going on, and it's about actually implementing and getting results. And the actions being taken are quite varied, and I would say they are still insufficient, but they are substantially progressed from where we were 3 years ago. And the investment groups driving this, it's no longer just the very large institutions, it's actually progressing to the private equity funds and also owner-operators, also seeing family offices starting to think about these things. And, you know, what we're hearing a lot at JLL is investors are saying, you know, what do they need to start thinking about for acquisitions? How should they train up their investment teams? And, you know, these ESG-related questions are coming up with more and more frequency. And recently we conducted an EMEA ESG investment survey at JLL, and that showed that actually investors are now including premiums for greener assets, but to a larger degree, discounts to reflect transition risk. We're seeing that a lot more at the moment. But what are we actually seeing on the ground in hotel capital markets? So I'll start with some introductions, which I'll have to read because I can't memorize it. So first we've got Thomas Laxo. On my right, he's a partner at Capman Real Estate responsible for hotel investments. And Capman is a Nordic private equity firm active across different industries and real estate asset classes. They own 30 hotels spanning 5,500 keys, mainly in Finland and also Sweden. Capman is a signatory of the Science Based Targets Initiative and is a strong advocate of ESG with its actions to raise a social fund and also being selected as one of only 15 companies globally to test out best practices to decarbonize buildings. And then on Thomas's right, we've got Ayana Pascalido, who is a managing director at Henderson Park, leading portfolio management. Henderson Park is a pan-European real estate private equity manager with $13 billion of real estate across offices, hospitality, living, logistics, retail, and a focus on value-add and opportunistic strategies. They have 20 hotels under ownership in Europe spanning over 9,000 keys, and they're managed in-house by Clarent Hospitality. And then we have Caroline Teveas, who's a senior vice president and director of sustainable business at Pandox. And they are a leading owner of hotel properties in Northern Europe with a €3 billion market cap. Pandox hotel property portfolio comprises up 160 hotels with 36,000 hotel rooms in 12 countries, and most are leased to major brands. On the ESG front, Pandox got approved for science-based targets in 2023 and is one of the first listed companies to align with European sustainability reporting standards. And then last but not least, we've got Alex Jarrod, who's a managing director of ProInvest, responsible for asset management. ProInvest is an international real estate asset manager with a presence in Europe, Asia, and the Middle East, and $3 billion of AUM across 6,000 keys. And ProInvest has achieved the award of having Australia's first carbon-neutral hotel under the NABERS Environmental Accreditation Scheme, amongst other sustainability credentials across their portfolio. So, to kick off the discussion, I guess it would be useful to start firstly with what have you observed, what's changed in the last year in investment processes, in the last 5 years? What questions are your LPs asking? What questions are you asking in your investment processes?
Maybe if I can take a first go at that. And we work with a range of different investors from from private equity firms, from institutional investors, and as well as family offices, in our capacity as a GP, but also in our capacity as an operating partner. I think one of the things that has really stood out to me over the last couple of years is just the role of the ESG officer within an institution today. And first of all, they're a lot more prevalent than they were 5 years ago. There's a lot more of them out there. And I think second of all, the role that they play in the transaction process. So they are involved much earlier in a deal and working through a due diligence process, particularly around the technical due diligence side of things. They're really setting the standard that the investment should be trying to achieve, and the work that's going to be undertaken to do the due diligence to assess the cost and the timing to achieve that. So I think that's perhaps more on the sort of GP side of it. I think on the LP side, what we have seen is really areas of particular sophistication and specialization within organizations to really align with their organizational objectives. And that requires us as a GP and investment manager to have capabilities around those areas, and each organization will have their own area. But that really goes into the reporting side of things, and we need to be able to capture the right data, synthesize that information, and then report on it. So that definitely is amping up.
If I may jump in, from our side, we Henderson Park, 5 years ago, we set up our ESG policy as a firm. So we invest across sectors, not just hospitality. And for the last 5 years, we have carried out ESG due diligence for every acquisition. And then the findings of this due diligence would be included in the IC memo, and there would be discussed in the committee alongside other findings of the due diligence process. I think what has definitely changed recently is the type of ESG due diligence one would do. And having an office in mind, office is the bread and butter of the sustainability discussion right now. Maybe 5 years ago, we would focus on how we can obtain a green certification and what cost we need to get there. Whereas now, what we see is we need to include CRREM analysis. What's the net zero pathway for that asset? We even started recently. This started last year when we started looking at some deals with our second value-add fund. We are looking at EU taxonomy compliance as part of the due diligence process. Alongside everything else we used to do before. We didn't scrap the green certifications, but we are adding to it. And even though, I will be honest, we didn't look at these things in such a focused manner for hospitality assets in the past, this will be the case going forward. And coming to the LP side, I think we all read probably the same articles. There is disparity in how different LPs from different jurisdictions demand reporting from their GPs. I'm sure there are big differences between US investors or European investors, but I will agree with Alex that the minimum requirement that we all have to adhere to is getting our data. We need to know what we manage, and it's the only way to be able to improve and report on going forward. And I think that's common across the board, I would say.
I mean, these ESG acquisition checklists, from what I can see, there isn't a standard, but they're pretty extensive. I mean, what are the real questions that ultimately matter? What are you really asking? Because a lot of these questions, some of them, okay, you disclose them, but are there really deal changes?
Yes, in our case, we actually just list 3 to 5 bullet points for our transaction teams. We have been talking with a lot of consultants that want to put together papers, 20 pages. They don't really understand what they should look at. But I think the question for us as a real estate owner, having approved science-based targets, it's does the property has oil, gas? Because then we know we need to phase out the gas or oil boilers, and that will cost a certain amount. So I give them the cost for that. The EPC level, what kind of EPC level is it? It is a very energy efficient property. We don't need to put in too much capex. Is it a very poor energy efficient managed property? I give them the amount, per energy level, depending on the country, because that also varies. And also, what kind of ventilation system is it, or BMS system? Do they have it? Otherwise, they have the cost. I would say these are the biggest costs and biggest risks for us.
And what if it's a listed building that could be considered a trophy asset, and you know that ultimately you can still sell it for a certain premium? How are you approaching that? Because there will be limitations to what you can do there.
No, but this is also what I like with science-based targets. We don't need to do all our properties, so we can do exceptions as well if it's a certain, trophy asset that is very valuable from other strategic decisions. So we really try to prioritize very hard, because you need to do that to meet your targets. But you don't need to go on all properties. We don't focus on our smallest properties, for example. That we won't get any good returns for that.
Mm-hmm. And Ayana, you were talking about, you're asking questions around CREM and EU taxonomy alignment. Is that actually being achieved? What are you actually seeing? And is there a return on investment for doing that?
I think it's a bit early to say if there is a return on investment from our side, for sure. But there are different drivers requiring us to do this type of due diligence. And this is regulation from our perspective, regulation for us, but also regulation for the buyers of our properties, and I think we'll come to that later. Regulation for our lenders requiring us to demonstrate that we are carrying out certain processes at asset level, and this helps with financing either at entry or upon refinancing. So I think there is definitely a need to demonstrate that we have considered the costs that are required in order to reach a certain pathway and certain level of compliance. Nobody is asking us to be compliant day one. That's not the goal here. But our job as value-add investors is to maximize profit for our own LPs, and we need to include in our underwriting upfront, as Caroline said, all the costs that are required to get there. That's actual financial investment, but also time. And depending on the property, even if you have a shopping list of actions that you can take to comply, you may not be able to do all of them because of the status of your property and the occupancy level, or you may not get vacant possession, for example, to make some substantial changes. So all of these have to go into your underwriting. It's not the black and white. So it's a process. I wouldn't say that there is. I cannot put a number on it at this stage.
And what about you, Thomas? I mean, I wanted to bring two panelists from the Nordics, because Nordics, just as a region, is a lot further advanced in the ESG mindset on all fronts from what we're seeing. The grid is greener. What are you seeing on the ground from your perspective?
Well, first of all, to your first question, I would say in terms of our internal processes that where a few years ago it was a good to have, now it's a must have. But of course, to your point, if it's a historically protected asset, then there's this kind of a, let's say, balancing act. To Caroline's point, maybe that's the exception. Then we say the historic preservation is more important than some of that. But on a balance, of course, big picture. So we're definitely seeing in the Nordics that they're just from everyday people, consumers, guests to we're thinking about that we're in hotels. I think that we as real estate owners, and I don't want to speak for everyone, but for ourselves, that I think that because some of the guests in the Nordics have already been asking more, even our operators, our tenants in that case, who lease the hotels and operate them for us, have been actually, in many cases, ahead of us. So been, say, certifying properties on an operational basis much earlier, and then, let's say, the property ownership kind of following, and that's why also we signed up to the science-based targets in the building pilot project, because of course something has to be done. We all realize that, but we also realize that that by leading into it and trying to lead, at least you won't be left behind. And I think that's kind of the approach to it. So we're all learning in the process, but it's, let's say, the motivations and pressures are coming from all directions.
And could you tell us a little bit more about this pilot project? Sounds really interesting.
The short answer is no. One, I'm not equipped to tell you all the answers, but we're still in the process. So we literally just started the process, and some of our, so they have already approved our long-term targets, but not also the, but for the actual building project. So a lot of information is being submitted that they're currently reviewing. So maybe next year I would have more to tell you about it. But it's a journey, and the idea of this building pilot project is to really help come up and test methodologies with real data. And the idea is that these 15 companies globally, therefore in Europe and elsewhere in the world, that they're providing data, they're all adhering to the same standards, and you're trying to kind of then have real test cases so you can really compare apples to apples. And I think that's kind of the underlying theme that has sort of been outlined earlier this morning.
And what about for fundraising? Is it helping you, in terms of your commitments to ESG and science-based targets?
So in Europe, yes, I had a conversation with an investor in the US who shall remain unnamed, but who said, "What is ESG?" That investor was just very open about it, that they're not there yet. States vary, so if you go to California, it's different. If you go to maybe Texas or Florida, again, that's maybe the other end of the spectrum. They're not there yet. But I think all can appreciate, and I think that's something that we look at when we evaluate in investment opportunities. Like, what does your exit look like? If you want to have a wider pool of potential buyers, you want to, for the benefit of your investors, have as many boxes ticked as possible so that you don't find yourself somewhere where, it's now stranded. And if you have to get technical about it, you already missed the train. So, and I think that's definitely something that whether some people are willing to acknowledge or not, they'll have to confront it eventually.
Mm-hmm.
Can I also add the perspective of the banks? I think that's also very important. Not only the investors, because in the Nordics, the banks are very, very active in asking for, having sustainability-linked loans. But this is just the first step, and within 3 to 5 years, this will be a hygiene factor. So they are really pushing us as a company to get on the pathway, and they could do it through the refinancing. It's not about the rebates, it's ridiculous if you ask me, it's very small amounts, but it's the power of them being the financial institutes.
What questions are they asking when you're looking to do refinance? What new questions are coming up?
Yeah, if they are doing the sustainability-linked loans, they are, tying our refinancing to KPIs. So for us, it's, for example, science-based targets. The banks love it. If you have science-based targets, they will love you. They also look at your industry, of course, and specific the risks per company. For us, it's the supply chain. In construction, we need to do site visits. We also have a KPI where we are trying to push economic financial incentives in bonus structures. So it will really make the science-based targets being implemented. So I think the bank perspective is important.
I think we're seeing some of that too. We don't have science-based targets as an initiative in my company, but we see that across the board, all sectors, lenders will not only try to understand our own ESG policy, but they will understand they will ask what is the plan for this specific asset in order to make it greener. And there is not one standard that they follow. I think different banks have different requirements, and I think that's one of the challenges in the financing industry right now. But again, you need to demonstrate your data, I think, demonstrate that you're doing a CRREM pathway, demonstrate that you're getting renewable energy wherever you can, and demonstrate that you're following a specific plan and reporting on it. I think this is the minimum that we see.
Yeah, I would certainly echo that. I think in our recent experiences with green loans, not only are we achieving a certain standard which surpasses their hurdle, but beyond that, we are collaboratively aligning around a number of initiatives to take the asset even further. And I think the banks are really going from being, I would say the banks are not just box ticking, but they're actually having a more proactive, involved role in the assets journey. And I think that's certainly becoming clearer over time.
And which questions have you seen them asking, the banks?
So in terms of, I mean, there are certain there's a very clear framework with a number of the more advanced banks around what requirements they need in order to qualify for a green loan. And some of those will be external, like EU taxonomy, and some of those will be internal. And depending on whether it's a green loan where you're looking to achieve a certain standard, or whether it's sustainability linked, in which case you're trying to show a certain journey, it's all fairly transparent. I think, beyond that, I think they are very receptive to, as part of a competitive process in obtaining the financing, really identifying a number of further mutual objectives that you can achieve together through the journey of the loan.
I would add to that, we have some properties, not in the hospitality industry, offices in this particular example, where we underwrote a specific loan or CapEx loan with this particular bank. And then through our feasibility studies, the first year of ownership or discussion with in-place tenants of what we could do and achieve at the property, it became clear that we could spend much more. More than one lenders have been receptive into upsizing, in the current environment, our loans in order to finance further green initiatives in the property. So they're open to it.
If I may add to that as well, because I literally had a conversation with one of the banks yesterday about the sustainability-linked loan. And I have to say, and I can't speak for all of them, but certainly in the Nordics we see that banks are getting more and more sophisticated. They have a lot of really competent in-house capabilities. So they can cut through the noise and buzzwords very, very quickly. So maybe something a few years ago, if you just put a few nice slides and stamps and acronyms up there, they might have been impressed. But now I have to defer to our ESG experts that on those discussions. But what was really interesting is where I guess when they started the journey, some of the banks in the Nordics, and were focused on the E part of ESG. The bank in our conversation yesterday, as part of a collection, a group of KPIs that we agreed to, the bank themselves proposed some S component KPIs as part of it, because
what
sometimes.
They asking?
Well, yesterday was more of a workshop where we were kind of brainstorming different ideas. But for example, one thing, for example, was tenant satisfaction, so because there are certain, the bank was certainly wanted to make sure that whatever KPIs we mutually agree to is something that is ambitious, but something that's also theoretically possible. Because if you just say, okay, fine, we'll see, and it's take a leap of faith, to a degree you have to, but I think it's important that they still had motivation that if you do the right things and everything goes well as planned, that you also have a chance to achieve those, and that as a result of that, you of course have slightly more favorable lending conditions in terms of interest rates that you pay.
But that's quite marginal at the moment, right?
At the moment it's more marginal, because I think it's something everybody is learning in the process. But I think that it's just a matter of time that is going from marginal to more
Absolutely.
significant.
I think with the regulation, the green asset ratio disclosure requirements, there will naturally be a shift. But in terms of these KPIs, I think maybe 18 months ago, these KPIs were probably led by the borrower, and then the lender would likely accept that. There are green frameworks, but what are you seeing now? Are you seeing them driving that a lot more? Because it definitely sounds that way. And what are the implications of not achieving the KPIs?
I think the first point to that is that banks are, let's say, motivated. In some cases, maybe they're under pressure themselves to do something about it. So I think they are actively, at least in the Nordics, scouring the environment. If they see something, we say, hey, actually, here we have a chance to maybe offer a sustainability-linked loan. Once they see, of course, that you have a plan in place where there might be a match for such a loan. So they're definitely, I think, many of the banks are now. I think there's some banks that are leading it, and others are kind of tagging on, because in our case, for example, we're talking about syndicates. So sometimes you'll have somebody driving it, and the others just kind of signing on to it, and through that they'll kind of be adopting some of those practices as well.
Mm-hmm. And Ayana, what about you? So just thinking about the multi-sector experience, what are you seeing? What differences do you see? From a hotel perspective versus, say, offices. What do you see as the challenges?
From the stakeholders' perspective?
Yeah.
I think that's a good question, because I agree with what we've heard, that, let's say, lenders in this particular example are more sophisticated, but I think they're more sophisticated in certain sectors versus others. And I think office is, as I said earlier, the poster child for what one can achieve with sustainability measures. There is a clear value implication in the current market between the ESG compliant properties and the non-ESG compliant properties. Office tenants don't want to rent non-ESG properties no matter where they are located. We are talking about the most sophisticated corporate tenants. They're looking for premises they're ticking all these boxes. So there is a clear polarization in the investment value of the properties. Do we see that in other properties at this stage? Perhaps not so much. But I will echo what Thomas said around our exit. Ultimately, the similarities lie in your exit plan. We are a value-add investor. Our job is to invest in the property and sell it within 5 years, for example, after investing capex. We tend to own larger properties, so probably the average buyer of our property wouldn't be a private individual or a high net worth family. It's probably an institutional investor, and these institutional investors have more and more increasingly higher requirements, ESG requirements, maybe through regulation themselves, because they also have to report. Excuse me. They also have to comply with SFDR or other types of regulations, or because they are driven by their own LPs, for example, so their own investors. So we need to maximize the pool of buyers. We need to be able to tap into European buyers, who are one of the most sophisticated pools right now. And therefore, inevitably, we need to demonstrate that we will be going forward, taking all the actions necessary to set processes in place at firm level, at asset level, with our suppliers, with our operating partners, vis-à-vis our lenders. And we will have the right budgets in place to implement these actions. And at that moment, we will be able potentially to sell to an Article 8 or Article 9 fund. Our funds are not Article 8 or Article 9 right now, but we will be selling our properties, hopefully. We want our properties to be attractive to these funds as well. And this is what is driving this.
I mean, in offices, we're seeing that a lot already, because a lot of the properties, they're not fit for standard. And there have been examples of hotel conversions, former offices, where if you look at, the downside protection is you can go back to offices. Actually, that doesn't seem to be the case, because this former office actually can't be an office anymore. And in the city, we're seeing a huge amount of offices being offloaded. And I don't know if the city is going to be just full of hotels at some point, but there are a lot of hotel investors looking at these office conversions at the moment. And it's the corporate demand is just driving the requirements as well. And that's been quite interesting. So yes, offices have seen that premium, but in hotels, it's a different animal, because they are operational. And just leading into my next question, Nordics is much more of a leased market. It's majority leased hotels, not managed. What do you see as a difference between leased and operational hotels? What do you think is the opportunity?
I'll be honest, we probably own one small leased hotel. All the hotels we own are hotels that we can operate and manage, because it allows us to capture the profit ourselves. In my perspective, in a very simplistic way, this gives us the opportunity to do more at the property. We have more freedom around what we can do at the property if we can operate them. But that's all I could add.
What about you, Caroline? The majority of your properties are leased.
We see absolutely an opportunity, especially when CSRD will also be implemented by the hotels in operations, because then we will sit at the same table. Still, it's very hard to negotiate and have agreements with our tenants, actually. We are starting to see a slight shift, actually, since last year, and we have now 3 green agreements in place. But I think the opportunity will be very big when we both have a more proactive way of working together and not in silos. Operational-wise, of course, it's our own pockets, and we often see ROI-wise 2 digits in ROI. So it can be very profitable, and also be able to share this with a tenant.
So you're able to collaborate with the tenants, because
Yes.
sometimes that can be quite challenging.
Yes, and we have really made own profit, and we know what we can earn from both parties, both from CO2 emissions or more energy efficiency, or also from a investment point of view. So everything goes hand in hand.
I guess my question would be, do you pay for these costs? If there's a property to be upgraded,
Yes.
that's leased, who carries the cost? Because I think that's the
Yes.
question across.
But it depends. I mean, we can of course take the investment cost, but all the savings often goes in the pocket of the tenant. So we are not a goodwill company. We need, of course, to maybe increase slightly on the rent. And I think that mutual understanding that we are both business companies needs to be, really understood.
Can I just ask one very quick, well, I'll try and get them to answer it quickly, but it's a question that keeps coming up. Are premiums being paid in hotels, or is it more a situation of discounts for transition risk? What's your take on that? And that applies to anybody here, and we have to be quick.
Real quick, I would say it's a spectrum. I think there's a penalty for the really bad ones. I think they'll premium if it's really, really super sustainable. And I think that spectrum is going to move over time.
Yeah, I guess I would echo that. We hope that there's going to be a premium, because we've worked very hard to develop a scaled portfolio of well-invested, sustainably efficient hotels, and would like to see that be acknowledged by the market. But yeah, I think the big challenge we've had over the last couple of years is we haven't had the transaction volume to really extrapolate a correlation between green and premium. But I think we're all hopeful that that will change, and I think that will start to create enough of a precedent, which will have a follow-on effect and really allow asset managers to underpin their underwriting around CapEx initiatives that really have positive benefits on the investment.
Hopefully we'll see that now that more transactions are happening.
Yeah.
Yep.
Thank you very much.
Thank you.
Well done.
Thank you. Thanks, everyone.
Thanks, Rika.
Thank you.
And we're going to break for coffee in a minute. Just before we do, one of the things I have to do is to just try and summarize what we all heard.
Thanks very much.
Art is going to put another question up on the screen for us. But whilst he does, if I'm just listening to what I heard, I think, which is great actually, first of all, I heard we need technical knowledge. Did we all hear that from them? That it's not enough now to think this is a generalist skill. We need to skill up. We need to knowledge up, which is why education is so important. So first of all, I heard that. Secondly, I heard it is about data. This is absolute music to my ears, but it's true. It is about data. It's about evidence. Thomas, you spoke about evidence and data. We're all becoming academics, basically. It's wonderful. And the reason for that is that we need, as Corey was saying, decision-useful, comparable data, so that we can integrate this non-financial data with financial data, right? Then we've got a real chance at succeeding in all of this. We need both cost savings, which I also heard, but also return on investment. And there's 2 sides to that, right? So it is true, if you do a lot of this stuff, there's quite a lot of evidence now that you can save operational money, okay? I mean, in terms of the P&L. And there isn't quite enough evidence yet on the upside, but actually, I think there's the beginnings of that. And in fact, our next session will go into that a little bit. But the other thing I heard very clearly was, and I hope we all really get this, what Corey's laid out is part of a regulatory ecosystem, which is the regulators are all working around the world in a surprisingly harmonious way that maybe a lot of us don't understand, but it's true. And this new language that the IFRS are trying to create, they call it a language, by the way, just like we do, is going to be a global language. So I think, frankly, we should stop doing whatever we're doing. We should stop the arguments about, is this framework better than this one, or is this guideline better than that one, or I've been doing this for years, can I not just keep going? We should forget about all that. Caroline, I think you're 100% right. It will be about IFRS, S1, S2, and the ones that are to come, because accounting is the language of business. That's what we all use, okay? And the leading regulators in the world are the EU. Okay, the EU taxonomy, the principal adverse indicators, as they're called, there's 21 metrics. They are the core metrics that every other jurisdiction will probably go to. They'll add bits here and there, but essentially they are a really good block. So I think we should all just stop mucking around. We need to get focused on the common things. They're a very, very good place to start. They're going to come anyway, so you may as well get up to speed right now. And the sooner we start collecting data against those metrics, I think it's really going to advance all our businesses a lot. Finally, just very quickly on the banking side, we've heard a lot. I think the final two things I said, that I heard was one, I love this idea about why wouldn't you appeal to the widest pool of buyers you possibly can. It doesn't make sense not to. So that's, again, obvious and I think an interesting point. On the banking side, very quickly, for those of you who aren't aware, banks now, as of 2024, have to report on the proportion of their loan book that is sustainable. Okay, it's a new thing called GAR, Green Asset Ratio. Okay, that applies to all companies that are caught under, have to report under CSRD, okay, i.e. the big companies. Okay, but it doesn't include, obviously, non-EU based companies or small and medium-sized businesses. So in July, there's an extra ratio called BTAR, Banking Book Taxonomy Alignment Ratio, okay, which includes SMEs and non-EU domicile companies. If they're doing business in the EEA, any of you who are American or Singapore, Asian, any of those companies, British, we have to now report under BTAR for the bank. Okay, so the banks are looking to improve these asset ratios. David and I did a little bit of work on this. There's beginnings, hints maybe of evidence that banks can raise equity at about, a little bit of a discount, about 50 basis points, we reckoned, in a year, if they can demonstrate that they are improving, these ratios and actually lowering their own carbon. And of course, all the lending they do is their scope 3. Okay, so banks have a real incentive now to start giving us money, provided we're doing good things with it under these new GAR and BTAR. Okay, so I think the banking point was a really interesting one.